One of the most valuable lessons I've learned over the past decade in real estate is how essential it is to learn from the industry professionals. That's why I'm gathering professionals from across the country to share their experiences with you. This is a Gregerson's podcast, where experience and passion come together in the world of real estate. I'm Casey Gregerson, your host, and I'm very excited you're tuning into today's episode. I'm very excited to introduce you to our guest today, Pete Kavanaugh. He's got a lot of experience when it comes to doing funds and working with investors and helping them get good returns. And ultimately, he's just a super transparent guy. You're going to learn a lot, very detailed, very analytical. So I hope you guys enjoy this episode as much as I do. I started building it all out in Go High Level. Like, I brought a ton of people that I've had lunch with or conversations with, dumped them all into there, and now starting to put them in like either an email campaign or a text campaign. And then I created like a pipeline to basically move them from, I could even show you, but basically from a lead to discovery call, talking about the fund, to like reviewing documents, to like a lot of them I feel like I'll go into a drip at that point where they're just kind of like, they're reviewing it, they're not ready, but I want to stay in front of them. If they're on social media, they're just seeing it, right? But I feel like there's a lot of investors that I'm talking to that aren't on Facebook or Instagram that aren't getting that constant like, hey, here's what he's doing, staying in top of mind. So I wanted to create like an email campaign to do that.
Yeah, I feel like there's a generational shift in kind of what's going on with technology, right? So, I feel like I've got kind of three bands of investors, like you're 60 and older, you're 40 to 60, and then your young professionals who've been, really successful at something in life, whether it's a high-paying W-2 job or investments of their own. It's that latter group that is, getting the feed on social media and stuff like that. But the other two groups, they either want to meet with you in person, they want to see the documents printed out, they want to see you on LinkedIn. My LinkedIn has been exploding lately. I've got to put some more effort into that. It's tough because you got to create stuff that speaks to each of them. I personally do not do a ton on social media. It'll be part of my strategy eventually. It's not necessary right now for what I'm doing.
Yeah. Where does most of your lead flow come from, you think?
Mostly word of mouth and relationships. Somebody once or twice removed that has invested me especially people invested me in the past, they'll tell 10 of their friends, hey, I've got good returns on what Pete and his team is doing. You should check it out. That's been the bulk of it, honestly. Like, we haven't really had to go into a large marketing campaign or anything like that. We've put a ton of development into our website, and I'm actually doing a ton of updates on that this week to expand it even more. But right now, my website is more of an authority builder. So if somebody meets me in person, first time they met me, maybe they got referred by Casey and they want to see what I'm doing, then they'll follow up on, I see them going to LinkedIn, or we see them going to our website to start to research our company a little bit more. So I'm investing more time and energy into the website to get that kind of filled out a little bit more, and then LinkedIn as well.
Yeah, that LinkedIn, I'm with you, man. I finally took some of your advice. Well, you gave it to me a long time ago. I'm finally executing on it. Like, I just went through everybody pretty much in my shell network on LinkedIn, and I figured that was a soft way to be like, hey, what are you up to? We should talk. And then been kind of booking some calls that way. And then my next step was get a VA, or one of my VAs, to go into like, because you probably know this, you can go to the secondary connections. And I was like, go pick this one, for example, this guy that was a high level guy at Shell, like go message every one of his second degree connections. And there's like maybe 150 of them, just something kind of informal. And then I'll try to work that from there into a call, which I guess the tricky part is going to be, I don't want to get on a bunch of calls with people. I don't know. I'm trying to streamline a VA to ultimately set appointments, but it's a tricky one to standardize. I don't know if you've got into like, how do you know when it's and you never get to know if it's a good call, right, with an investor, but a way to kind of filter them out.
Before the call or within like the first 10 minutes of being on a call with them?
Well, good point. I'd say before, both, but I'd say before the call, knowing like a conversation. In a perfect world, I'd have my VA trained up to where they could kind of lead a conversation, be like, hey, this person actually is thinking about has interest in being an LP, versus like me pitching them on it. Oh, maybe I might do that down the road.
Yeah, I don't have a great system for qualifying them ahead of time because most of them are coming somewhat qualified already.
Yeah.
So last night I had a great call, really brilliant dude who's done a lot of investments, but not so much private equity real estate. But he came highly referred from a good friend that he went to business school with, did his MBA with. Right. So just right from that moment, he's qualified coming to me because my friend, whose name also happened to be Pete, said, yeah, I've sat in this guy with class. He's aware of generally the investing that you're doing. He just doesn't understand the inside ins and outs of private equity real estate. Can you get on a call with him and kind of walk him through the stuff that's involved with it? So a really, really warm intro to it. And then the call went fantastic. I mean, there was certainly some education involved. We had to talk about metrics like IRR is a very, very confusing one for people that are not used to investing in real estate, like what it is, why is it important, how do you use it to compare apples to apples if you're looking at stocks, bonds, other alternative investment, other real estate things. So we talked about that for a while. Things like preferred return and waterfall structures, like what they are, why are they useful to a limited partner. So that was about half the call, and the other half of the call was just talking about my background some more. What have I done? What do I see in the market? Why am I pursuing the things I want to pursue? And then this particular guy was very risk focused. Like, hey, explain to me where the risks are. So we kind of walked through a few scenarios there of what happens if the project takes a turn here or takes a turn here. And I love those conversations because for my previous job, that's kind of what I focused on a lot was risk management. So I certainly love having those conversations with investors.
Well, on that note, how do you typically say on like you're targeting like a five, what's your kind of term on it? Are you targeting like a 5-year exit?
Yeah, so we have multiple stuff going on now, I think, since last time we talked. So it depends which one you're talking about. We have drifted into ground up developments. So those are shorter terms. So the one that we're raising for right now, it's a Reg D 506C to do a single family development, horizontal development. It's going to take 12 months. So that one's a pretty tight turn, which a lot of folks are excited about, especially the people that are new to our firm. So they see our tracker, they're like, you look great. Do you have something short I could get into? This is what we're offering them right now. Hey, try this out with us. It can be 12 months. We're projected to get your money back plus a return in 12 months, right? Nothing's guaranteed, to kind of feel us out. For the single family funds, Homeland Residential, which is the one you and I have talked about a bunch because you formed your own. That one we're looking at least a 5-year time horizon because it's just got different goals to it. That's more of a buy and hold and collect cash flow is kind of the main play there. Whereas the development funds are more, hey, we're going to develop a piece of land, rapidly appreciate it in value because we're bringing it to a higher and better use, and then sell it off for a profit. And then coming up here in the next 6 months, we're looking at some where we'll develop it and then hold it. So that'll be a different strategy as well. We'll bring in investors, say, hey, we're going to spend 2 years building and stabilizing this thing, refinance it, and then look to hold it for additional 3 years for cash flow. So we got a whole bunch of stuff going on right now.
And on the buy, so on like the 5 to 7 year hold with the single family, how do you kind of speak to the people that are like, because there's also a point after 5 to 7 years, if we're in a downturn, like it's not going to make sense to sell the portfolio, right? But how do you kind of tell those people, say, hey, just plan on this could go longer, but we're going to do the right thing? Or
yeah, it's all about fully disclosing it up front and clearly stating like this is my intention, but this is where things can go, right? So in that particular one, the planned exit strategy is at 5 years, but we have the option to extend it if we need it. And we point that out to investors right away. It says, hey, if it doesn't make sense to sell at this point in time, we're going to keep holding this for cash flow. And that fund is interesting because we take in assets that are stabilized already, so they're cash flowing from day one. So in the first quarter that an investor comes in, they're receiving a dividend. We did that in our first quarter of operation and have been doing it ever since. So it's not like we're holding people's money and not giving some type of return along the way if it's extended. Yours is designed similarly, right?
Yeah. We targeted a 4-year hold. And then, obviously, if it doesn't make sense. So again, if you get that kind of same question, the implications are if in your fund, for example, after 5 years, we're in a dip in the market and say it takes 2 to 3 years before it makes sense to sell. Ultimately, your IRR might be impacted a little bit, but you're still going to get cash flow. Is that kind of how you say, hey, we're mitigating some risk, but I don't know, versus I guess going down the wrong rabbit hole of them. Oh man, well now there's risk to my IRR, but it's like, no, it's really ultimately, this is a small risk you have, but we're mitigating it with your IRR might drop to this. Or curious if how you navigate that.
No, I mean, you're nailing it, right? And at the end of the day, we kind of encourage investors to do their own research as well. Those properties are primarily in Columbus, Georgia, which is a market not many people know about, but it's second biggest city in Georgia. And what I point people to is the last major recession. If you look at home prices across the nation, a lot of spots from 2004 to 2010, you have this sharp increase in prices, and then it fell off the cliff, right? And that's what most people remember when they think about the 2008 crash. So we took a graph of, I want to say it was San Francisco, San Diego, a few cities in Texas, Florida, New York, and we drew out that kind of curve for the prices, and then we overlaid the price fluctuation in Columbus, Georgia during that same time frame, and it looked like this. It was flat. Prices never skyrocketed up in that lead up to the crash, and therefore they never came crashing back down. When investors bring up the '08 crash to me, I always say, listen, you have to understand a lot of that stuff is a lot of the numbers you see thrown around. Number one are national aggregates. And anytime you're using national statistics to talk about real estate in the US, it's going to be massively skewed. It's just not good data to go off of if you're talking about pricing. Real estate is inherently a bunch of really, really small markets that congregate into those numbers. So you can't compare what happened in San Francisco to what happened in Columbus, Georgia during the crash. So the first thing you have to do is separate those things. And I'm sure this is probably pretty similar for your markets as well. I don't imagine there was some huge spike in the areas that you're doing all these rentals.
Exact same.
Exact same, right?
I haven't done what you've done to where we overlay it. I've been qualitatively saying that verbally, and any people who lived in Wyoming or and experienced it, they knew it, but it's a great way to just visualize it with data.
Yeah, and it's helpful because a lot of my investors have come out of California and Texas. Yeah, I mean, even the gentleman we were talking about last night, he was sitting in Southern California, and we were talking about pricing. He remembers them going like this. And yes, that's true for your experience there, but that doesn't apply necessarily to Columbus, Georgia. So yeah, I'd encourage you to put that graph together because it's pretty funny looking and it'll help articulate your points.
Cool, man. We can keep. You got your note. I assume you got your notes as well, or what notes you got? Actually, should ask that.
Yeah, we had a slide in here about assessing a sponsor, right? Which is what you and I are. A sponsor, the operator, the general partner, kind of all the same thing for the most part. But one of kind of the core values for me with Iron Horse Capital Group is really trying to educate people on this same path that you and I have walked on already, right? We both went to great colleges, had great W-2 income jobs, we're doing really well in our careers, and said, you know what, I want to try the entrepreneurial route. I want to apply the skill sets that I've gotten at this point in my life, and then change my life through real estate. And both of us have been doing that successfully. So where I feel like we as a company have resonated really well is walking people along that same path, not necessarily the entrepreneurial path, but saying, hey, listen, there's more ways to invest your money than just stocks and bonds. Nothing wrong with it. It's part of your strategy, but I believe that private real estate investments should be part of your overall investment strategy. That could be coming in as a limited partner. That could be as a private lender. That could be, investing in a REIT. Well, that's more kind of, Wall Street stock and behaves more like a stock. It is backed by real estate if that's what you enjoy. It could be owning rental assets yourself, Airbnbs, kind of any of that stuff. I'm just encouraging people to find freedom through real estate. Most folks don't know how to even start assessing a general partner or a sponsor. When you talk to Pete or talk to Casey, what are the questions I need to be asking them before I move forward with their fund? That is something we find people struggle with. Number two is how to understand the returns. I touched on that earlier. What is the difference between IRR and ROI? Why are they important? How should you weigh one versus the other? And then third is how to actually move forward. I mean, you've seen the SEC documents that Nick Moore puts together. I mean, my most recent one is 115 pages long. I mean, that's daunting. It's a daunting task to sit down and weave through that and say, okay, what am I getting myself into? Unfortunately, it's the nature of the beast. We can't make those much shorter because we have to protect ourselves and protect investors and make sure we disclose stuff appropriately as outlined by the SEC. But it is daunting if somebody's not used to that. So we spend a lot of time trying to educate people on the ins and outs so that they can make an educated decision. And if they invest with us, that's great. But if not, if they move on from us and sit down with Casey Gregerson and his team, they know the questions to ask to start kind of poking holes in your fund and deciding if they should move forward with it.
And a lot of investors or limited partners you work with, we just touched on this. You talked about like just going through the PPM, and this could be a very long document, as you mentioned, 115 pages. But what kind of advice do you give to limited partners, knowing that it's super important to go through that, but also it can be overwhelming? But just talk to the importance and how people can navigate that.
Yeah, I would say first, don't fall in love with the projected returns numbers. I see people all the time get excited about, a 25% projected year-over-year return on something. And those numbers are great, but don't get super lost in the numbers right away. I would say fully understand the business plan from the sponsor, right? So the first thing they're going to do is they're going to talk to you about that through their marketing documents. So if I'm pitching you and I'm saying, okay, Casey, you're going to come into our Brightwood development. Here's our plan. We're going to buy this plot of land. It's got a series of trees on it. We're going to clear the trees. We're going to go ahead and bring in, electrical, water, sewer. We're going to pave the roads. We're going to level the plots, subdivide them for single-family homes, and then we're going to sell that off to an end buyer who will ultimately build the houses on the lots. So I'll walk you through that plan verbally with my marketing documents. But when you get that operating memorandum that includes the operating agreement, which is how the company is run, private placement memorandum, which is all about risks, and your subscription agreement, you want to check that everything that you were discussing in the marketing documents is reflected in that operating memorandum. You don't want it to say something different or deviate drastically. And don't be afraid to ask questions, right? So if you're sitting with, I see a lot of these sold through sales reps, third-party sales reps, and sales people can be very salesy. So if you're getting pitched on one thing from the sales rep that doesn't match what's in the document, don't be afraid to ask a question on. Like a great question I got this week was on this offering, we're doing an 18% preferred return. And the person we were pitching on it, it wasn't clear to them that the fees charged inside the document were reflected in that 18% return, whether it was added on top of it or taken out of it. And he found the section of the PPM and just called me and asked the question. Said, hey, when I'm getting my 18% return, does that account for some of these fees you have in your document? And the answer was it does. The 18% was net of fees. But it was still a good question because I've seen other PPMs that are worded in a way that is not net of fees. And it's very misleading because you're put a salesperson put a marketing document in front of you that says, yeah, you're going to get 26% return. But as you start reading into it, that's the gross, and there's some fees that are taken out of that for things like sales and marketing and stuff like that. And it can really adjust your returns. And this isn't just a real estate problem. I see this in registered investment advisors that are selling stocks and bonds and stuff like that. If you really start reading into them, those instruments operate the same way. So first off, just make sure that the plan is clearly reflected in the operating agreements, because those legal documents are what the company is going to be held to. So if there's ever a disagreement in the future, that's what everybody's going to go back to, is those documents and say, hey, we clearly articulated in paragraph 56 that we weren't starting this project for 90 days or whatever the case is. The second big document is your private placement memorandum. And the private placement memorandum is all about risk. Risk, risk, risk. And that document is going to spell out absolutely everything that could possibly go wrong. And that's why it's so daunting, because there are a lot of things that could go wrong. It could be negligence of the operator. It could be a lightning strike. I mean, there's kind of crazy things that could go on. And it's important that those risks are discussed openly. So as you're going through those, I think ours is 54 pages for our last PPM. As you're going through those 54 pages, don't be afraid to ask that general partner, that operator, hey, tell me about the risks that are outlined here. What do you think the chance that could happen? How are you mitigating this particular risk? I'll give you two questions I got this week. Number one was about insurance requirements for the general contractors. One of our investors wanted to understand, how do we hold insurance and what insurance requirements do we hold the general contractors to in case something goes wrong? Another great question I got was about the actual contract between our firm and the general contractor. They wanted to review it and see what it looked like. Now, that particular client was highly sophisticated and has done development deals himself before, but that's the level of due diligence that he wanted to do to see if he can move forward with us or not. So those are kind of the big two pieces of advice I'd give with those documents. If I have someone that I know is a brand new investor, they're brand new to private equity real estate, I will schedule a time with them to go through those documents, right? So if I come to you, Casey, you're brand new, I know you're highly successful as an engineer, you got some extra money to put in. I say, Casey, here's our big pitch. I give you the nice, beautiful documents that kind of outlays everything, and you're sold. You say, Pete, this sounds awesome. I want to move forward. I go ahead and I send you over all the legal documents, and I say, Casey, let's schedule 30 minutes for you to sit down and ask me any questions that you have on these documents, because they can be daunting. And if you're not drinking coffee or bourbon, they might get a little bit confusing.
Love it. That's great advice. I love just taking a little bit of time, booking it with them. Like, hey, let's go through them kind of maybe high level, and then you can ask questions, but set the LP up to give him that opportunity to be like, hey, it forces him to get into it, and then no better way than just do it one-on-one.
Yeah, and the process should be all about transparency, because the worst thing for both parties, me or you coming in as an investor, is to get a year down the road and there to be a resentment or disappointment for how the investment is going, right? And that can happen on both sides of the street. From your perspective as an LP, you say, Pete, I thought I'd have my money out by now. And I can say, well, Casey was clearly articulated here, here, and here that this is the plan. Or likewise, we've had investors that want to get overly involved in some of the decision makings in certain of our funds, and that's not how mine are set up. We are real estate professionals. Like, we do this 24/7. So if an investor wants more control in a deal, they should talk to us about that up front before they sign the documents, and we'll decide whether or not that makes sense for the particular deal.
Yeah, makes a ton of sense. Pete, you talked about this one earlier, but for somebody who's just trying to, again, sort of base level, understanding IRR and understanding like preferred returns, but mainly IRR, like what's a good, easy way to kind of explain that to somebody who's just trying to understand what that metric means?
Sure. I've had a lot of practice with this one recently, so I'll give you my best pitch. So profit from real estate, making money through real estate, money comes in a very lumpy form, right? So normally do a real estate project, you have to bring a bunch of money to the table up front to either acquire a property, acquire land, do construction. There's a lot of cash outlays in the initial year, the initial time, to get that investment off the ground, right? So you got a lot of negative money that flows out first. Then, depending on the project, over the years, you'll have some cash flow come in. And that's normally through rents, right? So single family house, you got a tenant in it, they're giving you rent, and then some net profit comes off that. Or if you build a multifamily building, as you start getting it stabilized, you get some monthly rents coming in, and that applies for any commercial asset. So you're making some profits along the years, and then at the end of the project, there's a big windfall of cash if you've done it successfully, right? You sell it for some massive upside. So in that final year, you get a big sum of money that comes in. So when I say it's lumpy, that's what I mean. Is a lot goes out at first, some along the way, and then a lot all at once. So if you tried to compare that real estate investment in year one, where you're just collecting rents, if you tried to compare your return to that of stocks or a government bond or some type of fixed income security, it doesn't really capture the full picture because it's not accounting for that large windfall that's coming at the end. The IRR helps us solve that. So IRR is internal rate of return. So what it does is it looks at the totality of the project, and this could be applied to anything, but it's most commonly applied to real estate. Looks at the totality of the project and tries to smooth out the return over time. So it says, okay, in year one, negative cash flow because we're building it, got 5 years of positive cash flow from rents, and then a big sale at the end. And IRR takes that and says, okay, if we smooth that out, what would the annualized return be per year? In the case we were just talking about, your returns year to year could look like 0 in the first year. Maybe you're getting a 6% dividend for a few years. And then at the end, you're making 30, 40% of your money. It smooths that all out and says, okay, over an annualized term over 6 years, you're actually getting a 15% return. So now once you have that IRR number, if you say my IRR is 15%, now I could take that and compare that to other investments available to me. I could compare it to other real estate investments. I can compare it to stocks, bonds, et cetera, and say, okay, from strictly a numbers perspective, which one is going to give me a better return on my money? Now, from there, you have to evaluate the actual underlying real estate strategy. I've seen plenty of investments that are promising a 30, 40% IRR, but they're pretty risky. I don't know if I would choose them over a 7% return off a REIT or something like that. But it's a good start to compare apples to apples.
Got it. And just to simplify it, I know the math doesn't perfectly work like this, but to give people actual round numbers, if they invested $100,000, let's say they're projecting a 20% IRR. Let's use 15% IRR over 5 years. So they could expect that the actual money, if they put in $100,000, they could take $15,000 times 5. So calling it $75,000. Is that a good kind of rule of thumb? That's as much money they can expect in, right?
Yep.
Using easy math.
Yep. Using easy math. That's a good way to kind of calculate the IRR. Now, if you're evaluating one of these projects, like if you're evaluating ours right now, we would provide you with a pro forma that not only lists the IRR, but it will also have the charts, the accounting that shows how we arrived at the IRR. So you could back check the math and say, okay, Pete and his team are expecting these amount of cash flows here, and then a total sale here that brings the total net profit to this. If I bring 100K in, I'm a 5% owner of this, and you can kind of do the math and check it. And I encourage people to do that. Check the math, and if you're confused about the math, ask the general partner to explain it and how they're getting to the areas they're getting. Because the pro formas are a future projection. That's the Latin translation, right? The future
Yep.
projection of what this thing could perform is not a guarantee. And remember, that's not
Yep.
a guarantee when you're talking about private equity or real estate investments.
Got it. Pete, I want to get your opinion on this. So, looking at because you've set up several funds and looking at the underwriting and the performa, right? So, like in our fund, for example, we set up a low, medium, and a high scenario. And the math on that was we kept a lot of variables the same, but the big variable we changed was the rents, right? Because we might, if especially in a value add or a multifamily, if you especially as you start to multiply it by in our situation 63 units times just a little bump in rent, it makes a big difference, right? So we did a below market value rent, we did a market value for our middle case, and then the high case was, hey, I think there's a lot of data showing that market rents are going up, so hey, here's what it looks like if market value goes up, and just ran the same scenarios, again keeping a lot of other variables constant, so we're not changing too many things. But what are your kind of feedback on that as a way to kind of, that way you can show your limited partner, hey, there's risk, right? There's different scenarios, but here's kind of a range you can expect.
No, I think that's a great way to do it. Another way I've seen people articulate that same process, but the terminology they use is base case, best case, and worst case. And your base case is you're in the middle, conservative approach of, hey, I'm fairly confident we could hit this, and that's what I would use to in my pitch to sell investors. Say, hey, I am operating off the base case, so this is what you need to wrap your head around and say, okay, this is what I'm mentally prepared to receive. Here's the best case. If we get that, it's icing on the cake. And then here's the worst case. And then here's all the risks that could cause us to get to that worst case and how I'm mitigating the heck out of those.
Love it. Yeah. Especially the worst case too, to show them, as you mentioned, like fully disclosure, transparency on, hey, here are the risks and here's how we mitigate them. Here's what that could look like, can go a long way, I'm sure, if you do hit some of those hurdles in year one, year two.
Yeah. And that's why I appreciate your mindset, because with your engineering background, your mind, like you've been taught your entire career to focus on risk, right? No engineer goes out there and says, you know what, wind's blowing this way, we're going to wing it today, this should work out. No, that's not how the engineering world works. So when I see guys like you transition into real estate investing, you tend to do really well because you spend so much time mitigating those risks and finding those risks, and less time focused on the upside potential. The upside potential is great. It's there. It's what we're shooting for. But I found that operators are much more successful if they're focused on that risk.
Yeah, you just inherently in you as an engineer, that's your job, is to mitigate risk, and if you can apply it in real estate. And you're right, I think that's what separates a lot of operators, is just risk management and understanding risks. And ultimately when the risk comes or they're throwing a curveball, if they plan for it and can mitigate it.
No, you're absolutely right. And some of them you can't control everything, right? I had a mantra in my old job. It was control the controllables and influence the heck out of the variables.
Love it. That's good. Cool. Pete, you talked about this a little bit earlier, but go into, again, I'm a limited partner. This one might be one of my first funds that I'm getting into. Like some of the questions, kind of high level questions you would be asking the operator. You've touched on some of these, but just kind of in a kind of quick summary, what are the questions you would ask if you were an LP interviewing an operator?
Yep. So I've got 5 here right now. The first is market knowledge. I mean, we started this call by saying, listen, real estate is not a national number, doesn't really capture what's going on. So when you're coming into a deal, you want to know what is the sponsor's knowledge and footprint in that market, right? For example, I've seen some investment firms that are selling deals and they're in all 50 states doing deals. Kind of hard to be an expert in all 50 states, right? So if I'm dealing with an operator that's that spread out, I want to know, okay, what is the experience for the portion of your team that's running this deal in Kentucky that I'm trying to invest in? For us, a lot of our projects are either in the Columbus, Georgia region, or up here in North Carolina, either around Raleigh or Charlotte, right? And I live in the North Carolina area, so I feel like I'm here every single day. But I've got a team, I've got contractors, and I've got lawyers and accountants that really, really understand the insides and outs of North Carolina. Georgia, I've been operating in Georgia for 12 years. A lot of times when I'm doing something in the single family realm, as long as you tell me the street it's on, I can tell you roughly where we need to buy it without even looking at the deal, because I've just been there for so long. I've had some amazing conversations with different limited partners in these different markets. Some that kind of want to know my general overview of Georgia. I've had one guy who knew Columbus, Georgia really well. He had lived there twice. So we had a fantastic conversation on kind of area by area where we see rental trends, where we see trends with tenants and stuff like that. So go as deep as you want to go with that sponsor on their market knowledge. If they are not giving you the answers you're looking for, they probably don't know that area too well, and you either want to move on, or you might want to say, hey, let me talk to somebody on your team that's the one that's actually running the deal, or the one that actually did the underwriter. You might be talking to a sales rep in that particular company.
Yeah.
Number two, I would say is what's your team composition? And I would split this into two things. What's the team of the employees and the contractors that work underneath you, and then who are your advisors? Who are the people that you are surrounding yourself with to make sure that you are successful, right? So I know both of us, we've got a massive network of people that we reach out to help us kind of get forward, right? So as you formed your fund, you talked to me, you talked to a few other guys, and you said, hey, I've got this idea for how I want to share this cash flow and the profit with investors and make my company grow. Who do I need to talk to get this going? And I think I helped you a little bit, but then more importantly, I got you to your next advisor, who is Nick, right? And Nick from Robinson Franzman, the lawyer. He sets up 200 of these a year. He probably knows something, right? And those are the advisors that you're surrounding yourself with to make successful. And the team composition, you want to say, okay, what is your structure? What is the background for the project manager that's running this, or the general contractor that you've hired to actually build this? Who are you using for legal advice, for tax advice? Who's doing the accounting? Who's doing the investor relationship management? Understand the totality of the team. And I've seen fantastic teams that are small. I'm not trying to say you need some big, well-developed team when you're getting into investment. I know one investor who's controlling over $1 billion in commercial assets, and he's got 5 people on his team, because they're all just incredible humans that have been doing this for a long, long time. Third thing, we already touched on it quite a bit, is understand the risk in the business plan. Like, what are we actually doing? And the marketing documents, we'll get you there. Marketing documents can vary. Ours tend to be very in-depth because we tend to cater more towards investors that are kind of just getting into the private equity space. So we spend a lot of time educating people in our marketing documents. I've seen other marketing documents that are really kind of skinny and don't say a whole lot. They're kind of more designed to get an investor in the door, and then you can have a more in-depth conversation. But don't be afraid to ask those tough questions about risk, about the business plan. Like, hey, walk me through the plan on how we're actually going to get this thing built. It's okay to ask for education. I'm dealing with this a lot right now because a lot of our projects are horizontal development. And most people say, what the heck is horizontal development? What does that mean? What it means is we're taking entitled land and setting it up for a vertical builder. And that normally means bringing in utilities, roads, lot clearing, getting the pads ready for a foundation to be laid. But then we're selling that product off to a vertical builder, right? And there's a lot of pros to doing it that way. A lot shorter time frame, a lot less risk because we have our backside buyers set up already. It's a really neat investing strategy, but most people don't understand it if you just say horizontal development. You have to take time to sit there and educate them on, hey, here's my business plan. Here's how we came up with it. Here's the risks. Here's how I mitigated them. And here's my exit strategy. Number 4 is transparency. I think we've hit on this quite a lot already. A lot of this stuff should be transparent in the offering memorandum, the legal documents. It should lay out absolutely everything that you're doing. And I've got a few guys on my team that help me raise capital. And I tell them all the time, everything needs to be disclosed to anybody that's coming in as a limited partner. And we cannot deviate from what we're disclosing. I can't sell people on, hey, we're doing a horizontal development, and then turn around and build a carnival on the plot of land if I didn't clearly disclose it. Because not only is that not a good way to do business and illegal, you're not being transparent in what you're doing. And then finally is a record of integrity, right? So if you're dealing with a very seasoned operator, you could say, hey, show me other properties that you've completed and show me the final accounting, the final books. Show me kind of how you were able to perform for others. Now, if it's a newer operator, that's totally fine too. Totally fine as well. If they don't have that track record, you want to talk to other people that have worked with them, other contractors. Maybe they had other private investors that, somebody loaned Casey money in the past and said, yeah, I've worked with Casey on 5 or 6 homes. He did great. He gave me extra turn. Here's how he communicated. Here's how the documentation went. You want to find those other people that could help you with that record of integrity for the person. So those are kind of the 5 things I would look at: market knowledge, team composition, risk and business plan, transparency, and integrity.
That's great. Very detailed, but 5 big things people hit on. Love it, Pete. So Pete, another one, And you see this with real estate investors, right? They talk about this. If somebody's trying to just go buy their first house, buy their first rental, always this analysis paralysis, people that just don't ever take that first step. And then they look back 20 years ago and they're like, man, if I would have just bought that first house, think where I'd be. So I'm curious when you see that, when somebody wants to be a limited partner and maybe they've got colleagues that have done it and been successful, or they're definitely interested in it, but but they haven't done it. Right. So kind of, what have you noticed? Have there been any best practices to help those people ultimately, like, it's their decision, they got to feel comfortable, but helping them, because they definitely want to do it, but they just maybe can't need that little push. Any feedback there?
Yeah, it comes back to the education piece, right? So, the analysis paralysis happens when normally the limited partner is, uncertain about what they're getting themselves into. Like, we haven't done a good enough job to that particular person's liking on, hey, here's the entire plan. So to me, it just comes back to education. Second thing that's useful is having them talk to someone in your network that has successfully done business with you before. I think that's kind of the best thing you could do for a person like that, is, hey, get them in touch with that person that's lent money with you in the past, or has come in as an investor alongside you, so that they can understand their experience and feel a little bit more comfortable. I would say now is a tough time too if you're sitting on the fence, because there's not a lot of opportunity out there for real estate in general. I mean, anybody that's not involved in this industry, you can look on the news and see how hard it is to find a house right now, right? And we have an incredible shortage of inventory in the U.S. And the same is true for some of these private equity deals. There's just not enough of them to go around currently. So it is a tough spot to be sitting on the fence right now, because a lot of those deals might slide past.
That's a good point, Pete, because a lot of people, like, being a limited partner in a fund is allowing you to get into real estate in a very competitive market. As you mentioned, there's a lack of inventory, but also borrowing and just the ability to, like, buying power is compressed, right? So it's harder for just the average guy that wants to just get into real estate to go buy his first house. Really, the numbers don't often work, right?
It absolutely is. And that's on the single family side for our vertical there. That's our value proposition is, hey, listen, we've got a proven method for acquiring these homes off market at a discount. I've done over 140 of them, probably 150 at this point. We bought a bunch last week and this week. We've done a lot of them. We know it inside and outside. I've been through all the terrors of bad contractors buying bad deals. Like, I've done all that stuff already. So I know how to avoid it. So that's our value proposition. People's like, listen, being a real estate entrepreneur is really hard. It is really hard. There's some incredible risk to it. We figured out the system. You're welcome to come on board as an investor in different capacities and just work alongside with us, and we'll give you a return for going with us. I've taken plenty of people along that path. Some of them stay with us as investors and just kind of love that passive income. I've also got a few guys that came in as investors and then have since gained enough knowledge that they've gone out and are doing their own thing right now. I got a great Special Forces medic, an Army Special Forces medic who's out in Washington State. Came in with me several years, backed a few of our deals, made him good money. He asked a ton of great questions, was super involved in, we opened up our books to him. We opened up, how we work with contractors and all that stuff. And then he called me one day and said, Pete, I want to do this myself. I've identified a duplex. Can you look at it for me? No problem. Looked at the duplex. It was a great deal. He ended up living in one side, renovating the other, and then flip-flopped and then renovated the other one. Used all the money that he had invested with us and made with us to go into that deal. Since then, he successfully got that two units rented out and then pushed a triplex over to me. Helped him underwrite it, and he bought the triplex, and that's what he's living in now. So it's been really rewarding for me to watch that happen. Him graduate from, not knowing anything about real estate, being on the fence, coming in with us as in a passive role, to now actively doing his own thing and succeeding.
I love that story, Pete. All the time, talk to people that are, like, interested, want to be in real estate, don't quite have the knowledge, but they want to get going. So that's a great way. We call them swimmers, right? They can swim alongside you, learn the process. And then again, I encourage people, just like you do, if we can help you with a deal at the end of the fund or even during the fund with some other capital, and you could start to do your own deal, like, we love seeing that.
Yeah, you're absolutely right. I've had a few limited partners approach me about our turnkey investments. One of our models, like yours, is to create turnkey rentals. And they've come in to help us on the capital side to get the project done. And they've requested first right of refusal. They said, Pete, we're going to back in this deal. what is your projected exit price? What's your projected rents? What's your plan? And I let them know, say, okay, we're going to renovate this one. At the end of the day, we should sell it for 120K and it'll cash flow at a 7 cap. And they say, okay, we want first right of refusal for that property when it's ready. And we've given it to all the people that have asked for it. But that's another great way to get involved as well, is you say, okay, I'm going to watch Pete and his team or Casey and his team do the actual work, how they figured out, and they're inheriting all the risk in case something goes wrong. And then once I know it's a solid investment, I'm going to exercise my right to have first right at it. And if I don't like the property for some reason, don't exercise my right and take my profit and move on to the next one. I was going to say, you hit something great about the swimmers. I thought that was a good analogy.
Yeah.
I'll add another one for you. So all things in life take time, effort, and money, right? Like some combination of those. And not everybody is in a position to bring one of those things forward, right? Sometimes people could offer time, sometimes they could offer effort, and sometimes they could offer money. So if you're a person who's sitting on the fence and you want to get into real estate investing in some capacity, you say, I want to change my life in some small way by investing in real estate or being a real estate entrepreneur, I encourage you to try it. It's changed my life. It's changed Casey's life. Like, get out there and try it. But first, evaluate what are your strengths? Like, what do you have to bring to the table? For some people, that's money. For some people, that's, hey, I've got a high W-2 job. I've got a ton of money I'm sitting on right now, but my job is 60 hours a week, so I don't have the time or effort. So for me, the best thing I could do is invest 100K in Casey and further him by bringing money to the table. Some people don't have money, but they got a ton of time and they want to learn the industry. If you're in that boat, I'd say approach somebody like Casey. Say, listen, Casey, I got a ton of time. Where do you need help in your business? Where can I apply my time at no charge to you to help further you? And then I get an opportunity or an investment or coaching or whatever it is from you in return. And that goes with the effort thing as well. Like, if you don't have a lot of time and a lot of money, figure out what type of effort you could apply to help those people move forward. I've had some great relationships with people that have come to the table with, a myriad of those things. I'll tell you a great story. We had my ops manager had a meeting yesterday with a 16-year-old high schooler. Called in and said, hey, I want to help you guys find properties and I want to learn how real estate works. I've got no money.
Wow.
I've got a ton of time and I'm willing to put in the effort. And I think that's great. So we're gonna turn this. He's a junior in high school in the local high school here. So we're gonna turn him loose and see what happens. He cold called us. He found out about our company and said, hey, these are the guys I want to learn from.
Wow. That's super impressive. Very interesting.
Yeah, he's way more impressive than me. So
Love it. Cool, Pete. Well, I want to get you've also talked about this, but I want to get your summary on just your outlook on the market, right? Because I think might be a lot of people that are thinking, hey, well, why would I invest in real estate now when we've seen this crazy appreciation and now interest rates are high, there's speculation, there's worry about recession. Yeah, kind of speak to those people and why ultimately you guys are continuing to grow and go out and do more.
I love this question. Get this question all the time. And the question starts with a premise that we are acquiring real estate at current market values. So if I went out and I bought the house next door at its current market price, it would start here, right? And then would fluctuate with the ups and downs that you just talked about. So the initial premise doesn't reflect what my business does, and I don't believe reflect what your business does either. We are both acquiring real estate, whether it's land for development or existing inventory, at prices much below the market value. So on the single family home side, I'm typically acquiring a home anywhere from 55 to 65% of market value once it's fixed up, right? That is an enormous amount of space for the market to fluctuate. So if I'm doing if you're backing me on one of my single family flips or the foreclosures and stuff that we do, I'm underwriting that deal at an all-in of 70 to 75% of its value. That means I'm acquiring the home, renovating the home, covering all my marketing and overhead costs, and underneath that number. So I'm all in at 75% of value. That means that the market needs to adjust by 25% for me to lose. If you look at, throw out a national statistic, even though I don't like them. In 2008, the entire US market dropped 8% in over a year. It took it a year to drop 8%. So Casey, if you're backing me on a flip today, right, and I'm out there, I'm working my little butt off, and the '08 crash happens tomorrow, if I have a 25% margin in there and the market drops 8% over a year, we're still going to move that property. I'm still going to get you your money back, and we're still going to move forward. Development is similar in the sense that you're taking a piece of raw land and you are bringing it to a much better, higher use. And development is much harder. It's a much more advanced skill set than going out and flipping a home and stuff like that. It's much harder to do. Therefore, the margins in it are a lot higher, right? Because the developer needs to take risks to actually do it, and there's not as many people doing it. So what we've done in our company is we've paired that with the ability to go out and find the land itself below market value for if you're looking at just land prices. So one we're doing currently, I want to say the land is appraised at like 700 and we're buying it for 350. So just out of the gate, before we even tried to start developing, we've gotten a 50% discount on the land. So it's going to take the market a lot to move for us to be in danger of potentially losing our money. So in terms of the horizontal developments, the Brightwood one I've been discussing on this call, that one's up here in North Carolina by the Triangle. And you could read any article about North Carolina, it's absolutely exploding. North Carolina, South Carolina, Georgia, Florida, Texas, all these areas have been exploding for the past 5 years. And it doesn't look like there's an end in sight, regardless of where interest rates are, right? Because people still need homes. Whether they buy it or rent it, there's still a demand. And the interest rates kind of dictate which way they go, depending on the community. In our more affluent communities, like we don't really see the interest rates affected as much. If you're talking about Columbus, Georgia, yeah, every 0.1% change, really affects the consumer's ability to buy. If you look at the Brightwood development, it's a 12-month term. So starting from today, if I know my all-in costs are going to be under 75% and I'm selling it in 12 months to a backside developer, there's a lot of room in there for the market to go down before I start to bump up to actually losing capital. Like I could take a 15% hit and still be profitable for my investors and myself on that particular deal. Bringing it full circle, I do get that question a lot, but it starts with the underlying premise of you are buying stuff at market value. And that underlying premise is not true. And that's what differentiates, my company, Casey. I know quite a bit about your business. I know you guys are very adept at finding stuff off market as well. We're not buying stuff at market levels. So I think once people understand that aspect of it, they start to realize how much risk has been bought down in that process.
Love it, Pete. So you touched on that. One thing you didn't even mention, the other upside is typically, I know your single family fund does, and same with ours. If you do see that big correction, and let's say that it's an extreme situation where we drop below that, say, 25% margin you got, well, you hold, right? We're buying cash flowing assets that if the worst case scenario is you got to hold an extra 2 to 3 years and wait for the market to recover to get out, then that's a pretty good hedge, right? Pretty safe bet.
Yeah, and that's a great point in the single family world. So, I started investing in 2010, and a lot of my good investors or good mentors were investors that survived the '08 crash, right? So in 2010, Casey, there were deals everywhere. There were deals absolutely everywhere. And I was in my 20s at the time, and there was no money. Nobody wanted to lend because the world was ending. Real estate everybody had lost their shirt. If I could have bought everything back then, man, I'd be a billionaire right now. But I remember asking those mentors, I said, '08 crash happened. Like, what were the moves that you made to keep your business going? And they said, Pete, I didn't do anything. I had cash flowing real estate that wasn't over leveraged. I just stayed still. I stayed still, and I kept making net profit off the cash flow. And I watched as the world fell apart, and I kept stacking cash, getting ready for the next time I could start buying. And a lot of those guys started buying in the 2012, 2013 is kind of when I saw people start to get used to getting back into the market. And I'll be honest, man, at the start of COVID, I personally thought that was a black swan event. And a lot of the masterminds and networking groups I'm in, that's what we were all talking about at the time. Like a lot of those guys who had lived through the black swan event of '08 were recommending like, hey, slow down, stack cash. And that's what I did, honestly, all through 2020, 21, 22, is I probably missed out on more skinnier deals that I was kind of less comfortable with because I was stacking cash, making sure my business operations were sustainable in anticipation that there would be some massive drop off. Of course, that didn't happen. For two reasons, in my opinion. Number one was the massive amount of currency that we were printing. I mean, we were printing the GDP of Canada every single month. That's an enormous amount of fiat money to be pushing into the economy. That's a whole other discussion.
Yeah.
Kind of the larger thing was we have a housing issue in the U.S. We have a massive, massive housing issue, and I'm honestly surprised it's not discussed more. But to go back to the crash really affected builders first. All the guys we had so much inventory in the market that wasn't selling. When the crash happened, a lot of those builders got wiped out completely, and that industry hadn't really quite recovered. I mean, over the 10 years since, it still hadn't recovered. So what happened after '08 is the U.S. population kept growing, right? Builders collapsed. They started putting their business back together, started producing homes. But the rate at which we were producing homes, multifamily or single family residential units, did not ever catch up to the population growth in the United States. We were slowly, as a nation, kind of catching up to it, but we never caught it. And then in 2020, we slammed into COVID. Right. So in 2020, I'm going to mess up my numbers here, but I could send you a white paper on it. I think we were 7.3 million units short of housing needed to house our population. And we were slowly trying to close that gap. 2020 hit and all the government shutdowns happened. And overnight, that number jumped up another 5 million units that we were short. So we immediately just exacerbated that problem again. And I'll send you the sources for this, Casey. I'm forgetting it right now. But some of the national construction organizations, U.S. I'm going blank.
Yeah, I've looked at some of it. It's super interesting.
But they're projecting, 10, 20 years before we can get this problem fixed as a country. So how does that come full circle? We need houses. We as a country, we need houses. We need places for people to live. And the consumer really has two choices. You either buy or you rent. Typically, when interest rates are lower, that means the consumer has more buying power, and we tend to see people buying houses. So from 2020 to 2023, in my company, we sold a lot of flips on the open market because money was really cheap and it was easy for people to buy them. What I've been preparing for recently is for a shift back in the rental direction. So I touched briefly on Columbus, Georgia, which is one of our markets. The income for Columbus, Georgia is below the national median average and is below the median average for the state of Georgia as well. So the consumer there is extremely affected by every 0.1% change in the interest rates. So in that particular market, we've seen offers on houses, and our time on market the offers have gone down and time on market has extended because it's harder for the consumer to buy those houses. Now, once again, we're in at 75% of value, so I've got some room. I'm not worried about it. But if I juxtapose that to up here in North Carolina, in the Raleigh area, in the Charlotte area, the consumer tends to be a lot more affluent, right? And so interest rate hikes, they affect them, but it's not maybe as drastic as it is down in Columbus, Georgia, or Fayetteville, North Carolina is another good example. That's a military market we're in down here as well. That operates very similar to Columbus. So in those time periods of high interest rates, you'll generally see consumers push back into the rental side. So if you're running a business like me or Casey, it's important to understand, okay, how is this flowing in each market? And I touched on that already. In Columbus, for me, we're seeing people drift back towards rentals. In North Carolina, it hasn't really been affected as much because the consumer still feels like housing is affordable at the interest rates they're getting, which is between 6 and 7% right now. I think another thing to point out too, Casey, is over the past 40 years, a 7 or 8% interest rate for a mortgage is actually the average.
Yep. A lot of people don't know that or forget that.
Yeah. So for you and I mean, we're a little bit younger. So for our adult lives, we've kind of always known the 3 or 4% mortgage rate. That to us is norm. But it's important to zoom out and recognize that statistically, that's actually not the norm. A few generations before us were used to purchasing houses at 7 to 8%. My parents bought their first house, I think, with a 16% interest rate, 30-year fixed mortgage. Hard for me to imagine that, but people transacted homes during those times. So in no way am I minimizing the pain that people are feeling by the interest rate hikes. I'm just encouraging people to zoom out and look at the data for where we are.
Okay, so let's summarize that really quick. And let's take it real. This will be the last kind of one, Pete, is so let's take somebody who's kind of used to investing in stocks or other, or not as used to being in real estate, and is thinking about being a limited partner and being part of a fund, right? So we've talked about it is not risk free, right? We've talked about definitely the risks and knowing the risks, but the upsides we've talked about is what you just dove into is there's a lack of inventory. And honestly, interest rates could create more demand for rentals. We talked about our businesses are designed to buy at a discount. So we're buying below market value from the start. So you're kind of locking in there. And the last thing we haven't really talked about, which I want to hear from you, is the tax advantages, right? Because when you invest in the stock market or maybe another private equity company, you're probably not getting the same tax benefits that the US government gives us for investing in real estate. But limited partners in a fund, they participate in a lot of those benefits, right, Pete?
Yep. So the tax code is written to support private investment in real estate in general. Generally, that's because I believe that the U.S. government recognized that, hey, this is better kind of left in the hands of private individuals. So they structured the tax code in a way to really incentivize anybody to invest in real estate because it's useful to our economy and how it's run. If you compare us on the drastic end, maybe to a place like Russia, where it's not set up that way. The government is responsible for a lot of the housing, and it's just say not the greatest. So the tax code incentivizes real estate investors to do what they do. If you're coming in as a limited partner in a fund, you want to understand what the tax advantages are for that particular vehicle. I know in the ones that we have set up currently, all the tax advantages for us flows through to our limited partners based on their ownership percentage. So if there's something like depreciation or phantom depreciation on a property, that is getting passed through to our investors and could be a write-off either on that particular income or other income across their own personal portfolio. The question I get a lot is, okay, well, how does this fit for my particular situation? Not a CPA. So what I always tell people to do is say, hey, listen, these are the advantages that my particular fund can give to you. Take that knowledge, take the offering memorandums that spells out all these advantages, bring that to your CPA if you're trying to compare my deal versus Casey's deal versus another one and say, okay, here's what I have currently. Based on my tax strategy for the next few years, what's the difference between Pete's investment and Casey's investment? And your individual advisor is going to help you along that path because they know the inside and outs of your financials. I've gotten some great calls from very sophisticated investors that are pursuing investment strategies based solely around the tax advantages. And they'll deep dive into some of my deals and say, yes or no based on what they're looking for. 1031 exchange is a very common one. My structures are not set up for a 1031 exchange, but there's plenty of deals out there that are. So if you're a 1031 investor that's sold a property, you have to do a like-kind exchange or something else. You could go buy another property yourself, or there's vehicles out there like the Delaware Statutory Trust or a TIC structure, tenant in common structure, where you could come in as an LP and do a successful 1031 exchange. So that's a great advantage right there.
You nailed it. So yeah, to kind of re-summarize, and maybe from a higher level, because you made it. I really like your tip there, Pete. You're like, hey, you're going to get tax benefits by being a limited partner. Everybody's different, right? So take it to your CPA, let them make the call for you. That's a great point. But like big picture, you talked about phantom depreciation and just kind of like higher level, the benefits that everybody's going to get, right? And yeah, actually maybe quickly explain phantom depreciation and what everybody's going to get, and let me back up one more. So there's a difference between an active investor, real estate investor, and a passive, right? Most of our LPs are not going to be active. They're going to be a passive investor, but they could still write off some of that depreciation. So go into that real quick.
Yep. So phantom depreciation, basically the IRS says that you're allowed, they assume that a property is built out of wood and other materials, and that's going to deteriorate over time. So they allow you to depreciate a certain amount of money in what's called phantom losses. That says, okay, we're assuming that you're going to have to do all these things, so we'll give you a write-off right now that you can write off against the active income from it. So a phantom loss is not actually a true loss. A true loss would be, hey, I've had to spend $5,000 on an HVAC, right? So an actual cost incurred. So the phantom losses are fantastic, whether you are owning and operating a rental yourself or whether you're coming in as a limited partner. So for us, those phantom losses in our funds, the way they're designed, is to pass through to that limited partner based on the percentage ownership that they have. So whatever part of the pie that they're an investor in, they get that same size piece of pie for the tax advantages. Another strategy that we've had a few people pursue with us is the use of self-directed IRA vehicles.
I was going to ask this one. Self-directed IRAs. Great. Glad you brought it up.
Either a self-directed IRA or a solo 401k LLC, which is more for entrepreneurs. As an LP, they operate similarly, right? So it's a self-directed IRA allows you to take IRA or 401k money and invest it in non-standard assets. So a regular IRA needs to be invested by basically bank assets, right? Stocks with an investment advisor, any type of product that a bank would offer. Real estate as a whole is considered an alternative investment. It falls in the same category as if you're buying precious metals, or far into the spectrum would be art or collectible wine or collectible cars. So it allows you to diversify into that with your retirement funds. And the place I see people use this the most is in real estate or precious metals. So what that allows you to do is take your IRA money, invest it as a limited partner into one of these deals, and then whatever profit that comes from that is tax-free because it's going into a protected tax-free vehicle as designated by the IRS. There's plenty of companies that can help people set those up. If we're working with an LP that doesn't have one or has money in a traditional IRA, we basically just set them up with a few different companies, let them do their due diligence, and they can decide what to bring over. If you have a self-directed IRA, it doesn't mean it needs to all be in real estate, though. You can still invest in stocks and bonds and stuff like that. Just to open up that myself personally, in my self-directed IRA, I do have stuff in more traditional bank products, and then also heavily into real estate as well. So you're able to design it kind of how you see fit.
Good point. Yeah, and you can go find a LP, and to your point, or maybe kind of what our strategy is. Yeah, you could get. So you want to use your self-directed IRA as an investment vehicle, and you want to start to get into real estate, but you don't know where to start in real estate, or you don't want to go buy your own deal, or maybe you can't afford to buy a deal, right? Like you might to take down a real estate deal and because there's also limitations on taking out debt through an IRA. So the other way to work around that, if you only got 25 or 50,000 or maybe even 100,000, go put it in, go be a limited partner, and then makes it easier, right?
You're absolutely right. Yep. And there's even restrictions on how actively you can be involved with your own money. For me personally, I have invested my self-directed IRA money in other funds that are not run by me, that are run by close friends that are operators. I'm in an LP on other deals because I view it as a way to quickly grow that money in a tax-free environment. So, for example, if you came in on our Brightwood deal that we were just talking about, the horizontal development, I mean, we're projecting an 18% return in a year. I mean, that's pretty good. That's pretty good to have that all tax-free, right? So if you brought in 100K, if all goes to plan, we'd be giving you back 118K in 12 months, and now you have 118K to invest in. You can start compounding that.
Yep. Love it. Man, it's been good stuff, Pete. Any other ones you want to kind of share in closing?
I would say at the end of the day, I love educating people on this stuff. So if there's anyone that I could kind of further dive into, you're welcome to reach out to me through Casey. But yeah, that's kind of what I'm here for, is to help educate people along the way and help them find a path. If you go on our website, you'll kind of, the front page talks about all these different paths that you could pursue on real estate. And that's kind of what we walk people through. Is we sit down, Casey, you came on and say, all right, Pete, I've got 100K in a self-directed IRA. I want to invest in real estate. I'm not going to put a deal in front of you right away. I'm going to say, Casey, what are your goals? What are you comfortable with? What do you think about risk in real estate? What do you think about the real estate market? Do you think it's going up or down? What's your perspective on what I do? And we start educating them on all the different aspects of our business. So now Casey can make a decision and say, I really don't want to be involved with this at all. I like the limited partner role. I like kind of really just being a passive investor and going to trust Pete with it completely. Or Casey might say, hey, I want to be a private investor, or I want to buy one of your turnkey properties. I might want to be kind of more actively invested in managing something myself and get that experience before I go and try to do it out myself. And you don't have to pick one way. As I mentioned in the beginning, I've got that great special forces guy who came in and started on one path, picked some more paths along the way, and is now off on his own doing his own great adventures.
I love that, Pete. Two things. I love that you just bring people in and just understand what is their unique situation. Just like we're working with a home seller and we're troubleshooting, making the best solution. Same thing with an investor. Hey, what are your goals? What are you trying to accomplish? Get on a call, hash that out. And then the last thing you said is, hey, if you whatever path you decide on, that's just that path for now, right? You can continue to could be a swimmer and move into doing your own deals, or maybe do your own deal and then be an LP, or do the both at the same time. A
You're
lot of
absolutely
options.
right. I mean, this industry has changed the trajectory of my life, and I want to help other people along that same path.
Love it. Well, good stuff today, Pete. Last thing, where can people find you, and just let us know your website.
Sure. The website is ihcg.pro, Pro. It's Iron Horse Capital Group. And then you can email me at pete@ihcg.pro.
Awesome. Well, definitely reach out to Pete. He's got stuff. The cool thing is we do similar things, but in different markets, right? So if you want to diversify, want to be in Wyoming, want to be in Texas, want to be in North Carolina, want to be in Georgia, some of those other hot areas that you maybe can't get access to, Pete's your man.
Perfect.
As you may have learned by tuning into this episode of Gregor Sense, the easiest way to make real estate investing hard is by going at it alone. So as you continue learning and seeking knowledge of the industry, I want to encourage you to build relationships with other professionals who are passionate about real estate. Whether that's an agent, a business owner, or a managing investor like myself, there are pros that want to see you succeed and are willing to help you by sharing their experience. You can always reach me by visiting CaseyGregerson.com and scheduling a call. I look forward to connecting with you and continuing to share my experience with you here on Gregor Sense Mobile. Until next time, I'm Casey Gregerson. Thanks for tuning in.